Hello and welcome to CMC's monthly insights video, where we take a look at some of the highlights for markets over the previous month and what they might mean for the outlook for the coming month. In this video I'm going to be looking at the Asia Pacific region. I think it's fair to say that the run of economic data over the month in Asia Pacific was pretty mixed, and as a consequence of that we probably really haven't done a lot to change overall market thinking on the big picture outlooks. Like everywhere else, the Asian traders and our markets are very dominated by considerations of what's going to happen in the US, in particular what the Fed is going to do about interest rates and how quickly they'll rise, and how much fuel the Trump administration might throw on that fire in terms of fiscal stimulus. And it's likely that that's going to remain a major consideration for markets in the coming months. Turning firstly to the Australian stock market, the key thing there was, of course, that we had our very busy company profit reporting season. Overall, it was a strong reporting season with a significant growth in profits, led higher by the really stellar turnaround in mining stocks on the back of higher commodity prices, but also some very good performances in terms of cost control. For all that though, in terms of surprises compared to what was expected, it was a pretty mixed reporting season. Looking at this data from Bloomberg, you can see that in terms of their consensus surveys, the surprises were actually a negative 0.5%. There were 69 companies that beat the Bloomberg consensus, but there were also 64 that missed it. So that translated into a good enough result to hold the Australia 200 reasonably steady over the course of the month, indeed a bit stronger, but not really enough to get it going up above past resistance levels. In terms of the Australian economy, we saw some very strong data. I think the real standout was our trade data. We saw a crackingly good increase in Australia's balance of trade figures. With a very strong increase in our terms of trade, that is the price we get for our exports compared to what we pay for our imports, up 15.6% in the December quarter, and likely to improve much further given recent strength in commodity prices. That fed through into improved conditions in business, so the services PMI that we talked about last month did stay pretty solid. We also saw a very strong increase in NAB business conditions. However, all that relatively good news is yet to transfer into much good news as far as the labour market is concerned and wage earners are concerned. So Australia's job growth continues to be very skewed still towards part-time growth, and as a consequence of that, our wage growth is still very soft, up only 1.9% in the last quarter. Probably the other key thing in our markets here in Australia was that the RBA held rates steady in the face of weaker employment, but did note in several speeches that they are getting increasingly reluctant to cut rates any further, given the risks to a big increase in household debt. Over in New Zealand, the key feature there I think was also the Reserve Bank, with the Reserve Bank of New Zealand dropping its easing bias and saying that it is now moving to a neutral bias with no particular intention to cut rates, and that's on the back of a really good performance in the New Zealand economy with strong immigration growth, improving inflation, although the RBNZ does remain wary about international risks, including the political scene in various major places. Finally, in China, as has been the case for much of the last 6 to 8 months, the general run of data in China was really just consistent with this growth trend for the official data around about 6.5%. Really nothing there to upset market expectations. But one of the keys, I think, was a report by Chinese officials that they are working to introduce a property tax, or to expand that out in order to cool the property market there. The market took notice of that. That certainly is a possible headwind for the Chinese property market and therefore for metals prices like copper and steel over the course of 2017. So how did all that translate into key market action? I thought what might be interesting is to go back and look at 2 or 3 of the charts that we reviewed in the last monthly insight. And to begin with the Australia 200 index, I'd outlined the support and resistance levels there last month, and as it turned out, the Australian 200 stayed firmly within that trading range and in fact bounced off both the support and resistance. And what that's done is really entrenched this range now between about 55.95 on the low side and 58.27 on the upside, and at the moment we're heading down again towards the lower boundaries of that range. Turning to the Aussie against the US dollar, there we'd also looked at the big triangle formation that the Aussie dollar was in, and again the Aussie dollar has stayed within that. But very interestingly, and I'll come back to this later on, we are butting up to the resistance of that big triangle pattern, which could be an interesting development. Finally then, I looked at the US dollar against the Singapore dollar, just because it was such an interesting chart. We noted last month that we'd had this big 5-wave style advance in the Singapore dollar, suggesting that we were in a downward correction. Now, in the last month of the insight, I had sort of hoped that we might get some sort of rally in the US dollar Singapore, which would allow big picture traders to join the downward correction. That didn't really happen. The upward movements in this chart were pretty minor during the month, and the US dollar has just continued to correct, but the overall picture remains the same. It does look as though this downward correction in the US dollar could have a bit further to play out, and so any counter trend rally might provide traders with an opportunity to possibly get short, looking for the rally to play out further. So looking forward to what could be some of the key events over the month of March. Firstly, looking at China, I think one of the things to really keep an eye on there is the People's National Congress. The government is due to announce some economic targets on Sunday the 6th of March. Look there for their headline GDP number. Their target last year was a range of 6.5% to 7%. Some feel it may be a little bit lower in 2017, perhaps down to something centering around 6.5%. Look also for the extent of credit growth they're prepared to allow in the economy, with an average expectation for that to be allowed to be about 5% over and above the rate of GDP growth, which is really still very stimulatory. The other things, of course, to keep an eye out with China are their trade data due on the 8th of January, always very important, as well as their main monthly data, including industrial production and retail sales, which are due on the 14th. Japan, of course, one of the really big economies in the world, let alone Asia. There hasn't been a lot of change in that economy in recent times, but always important to keep an eye on what's going on there. Key dates there include, or figures there include, their inflation data due on the 3rd of March, and also, as always, the Bank of Japan meeting due on the 16th of March. In Australia, I think our Reserve Bank meeting also will be a focus, due on the 7th of March. No change to rates expected, but very interesting to see what they have to say, particularly about the risks of rising household debt. And given the state of the economy at the moment, with some parts of it looking stronger and a really good GDP growth number today, there's going to be a real focus on our employment data over the next few months, which, as I said before, has been weak. That's due on the 16th of March. This is volatile data, but over the coming months, the markets would be really very encouraged to see a greater skew towards full-time rather than part-time job creation. Finally, 16th of March, also possibly a key day for the New Zealand data with the RBNZ meeting due on the 16th of March as well, and again no rate change expected there, but they are actually one of the central banks apart from the Fed where the market is expecting that ultimately in 2017 they may even begin to think about lifting rates. So certainly the tone of what they have to say in coming months is going to be quite important. And finally, let me round things out by a look at what I think might be 4 key markets in the Asia-Pacific time zone over the month of March. First, let me return to the chart of the Australia 200 index, which is, as I've said before, inside a range and has been heading down quite strongly, really, over the past few days. If we were to find that support zone again down at the bottom of this range around 5,600 and show signs of rejecting it or bouncing off it, that would really be the classic sort of range trading buy setup for traders. But note that the momentum indicator, the slow stochastic in the box below the chart, is still quite heading south quite strongly with quite strong downward momentum at the moment. So if we just sailed straight through this support and broke beneath it, then that certainly does create the possibility that we discussed last month, that I think we could then be headed towards lower levels than the deeper retracement levels that I've got outlined on the chart here. Another very interesting market in the stock index sphere at the moment, I think, is the Hong Kong H shares, which are the big Chinese stocks available in China. The thing that really captures my eye about this chart is the divergence between price and the RSI indicator. You can see price had been making higher highs while the RSI is showing potential weakness by making lower highs. If from here we were to break support, that could see that market heading lower as well, perhaps again to the deeper retracement levels I've got outlined here. But the overall architecture of this market in the big picture looks bullish, so that for big picture traders, if we did see a pullback to those deeper retracements, that may be a potential buy opportunity depending on what's going on. My third chart is the Aussie against the Japanese yen, which is very interesting. I think we've seen this after the very strong rally after the US election. We've now seen in recent times this much weaker momentum rally, which has been confined neatly to the trend channel that I've got on the chart here. We're showing some signs of bouncing off it at the moment, although it remains to be seen how good that bounce off it will be. But a couple of possibilities here, given the potential weakness in iron ore and other prices. One would be that we do rally back to the top of the trend channel again and fall away. That would be the classic sell signal there with a close stop looking for a move back to the support and potentially a break. But the other possibility is that we do just go on to break this support fairly soon, and that also could indicate a fairly significant downward correction in the Aussie against the yen. And finally, another chart that I think is interestingly placed at the moment is the New Zealand dollar against the US, which you can see is also in this quite well-defined rectangular trading range, a much smaller one in terms of time. And given the sort of thing that we looked at with the US dollar Singapore and an overall bias towards a possible further weakening in the US dollar, if NZD USD was to find this support again on this channel and bounce off that, that also would be the classic buy opportunity, close stop under the support, looking for the price to return to and break through the resistance for a deeper upward correction in the New Zealand dollar.